ESOP is really the buyer of the stock, not the employees. So that trust that's created is going to be the buyer of the stock. The employees are going to have a beneficial interest in that stock. A bank is going to look at whether or not that company can operate without the business owner, if in fact that's their plan, is to exit. But more than likely they're not going to. But the other safety net for the bank is the knowledge that there is 70% of that transaction amount at risk to the business owner if that company fails. In the S Corp situation, 100% S Corp, there are no federal or state income taxes. Of course, in Florida, we don't have any state income tax, but around the country there would be. The ESOP would operate on a tax-free basis if it were an S Corp and 100% of the stock was owned by the ESOP trust. Construction companies, the construction industry in general is one that's somewhat difficult to sell in the open market and receive fair market value for the company. And because of that, business owners in the construction industry often look to ESOPs to get that accomplished, that sale accomplished, that transition accomplished, because an ESOP will pay fair market value for a company. I'm working with a company where the business owner is 40 years old, and they approached me about having a business plan to stay another 10 years with this company and then do something else. And so, he's way ahead of the curve.
I love it. Well, Manny, I gotta say, man, this has been a very interesting, informative podcast episode.
Thank you.
Welcome, everybody, to the next episode of the Construction MF'ers podcast. I am Scott Peper, CEO and founder of Mobilization Funding, and today we're going to talk about ways to exit your business, to properly plan for your business, all of the necessary steps that you may want to take to bring your business to an exit or a succession plan at one point in time are also going to be all of the same habits, structures, financial and other, that you're going to need. And I've got a great expert here today to talk about that. Manny Calzon, the managing director from Ambrose Advisors, here to walk us through it.
Thank you, Scott.
Welcome, Manny.
Good to be here. I appreciate it.
You too. How's it going?
Everything's great.
I love it. Thanks for coming on, man. I appreciate the opportunity to be able to have you in the studio too.
Absolutely.
We get to use the other side of the room, which everyone who does pay attention and watch us, we don't have the construction and effort side today. It's not me solo, so it's great. So tell me a little bit about yourself and Ambrose Advisors. What is Ambrose Advisors?
Ambrose Advisors is a boutique investment bank. And what we do primarily is sell companies. Our specialty, if you will, our focus is selling companies through a vehicle called an ESOP, which is a highly tax-advantaged way to sell a company. We also have an M&A arm, so we can sell companies in a more traditional manner. I would say probably around 70% of our transactions have some component of an ESOP in it. So that really is our focus and our expertise in selling businesses. We also have a TPA arm, which is a third-party administration arm. So once an ESOP is completed, we can stay with that client and do the record keeping and reporting for them.
There is a ton of reporting in that.
There is.
Yeah. It's funny you bring that up because I had a friend of mine who exited a business of his about 8 years ago through an ESOP. And then they basically went into another market and did the same exact thing they did in this business. And then they combined the ESOP side of the business and the new side of the business, and then they sold both together to a larger public company. And the administrative burden he told me about when they sold into the ESOP was substantial. To do what they needed to do to blend the two together and then sell them together, he said was the only thing that was more administratively burdensome than that.
Yeah, it's important that you have your house in order to do an ESOP, because an ESOP is really a trust that's created and it is administered by a fiduciary, a trustee. And the sale of that company to the ESOP is going to be a negotiated transaction that we assist the seller with. We're seller representatives. And in order for us to get the best price for that company, their financials need to be in order, their record keeping needs to be in order. So, because it is a third party sale, it's just to a captive, entity, that ESOP trust that we create.
So let me for everyone that is very familiar with the ESOP term, and I'm going to sell it to the employees, right? That's what I hear a lot of our folks say, and you want to do that. Let's get down a little bit more granular for a second, and just define an ESOP. So I'll say what I've heard ESOP to be, or understand to be, or heard it from clients, people that probably are listening. And then I want you to kind of help me understand like where the difference and nuances are.
Sure.
And so if I was going to say I'm selling to an ESOP, I'd say I'm going to sell it to the employees. You know, the employees are going to get together. They're not going to go get the debt, but the businesses that we've created together is going to be able to support a debt structure, a loan
Right.
from some bank
Right.
that is going to give the employees the money to pay me as the owner or group of owners for my exit in the business we created. And then they will own that business. They'll be able to pay the debt down, and then profits will get distributed amongst the employees. So
Yeah.
how is that right or wrong?
Well, to clarify a little bit, an ESOP is really the buyer of the stock, not the employees. So that
Okay.
that trust that's created is going to be the buyer of the stock. The employees are going to have a beneficial interest in that stock, and what that means is, unlike a traditional way of owning stock where you have voting rights and you have disclosures and be able to see financial statements, if you will, and how much salary maybe the business owner is making, that isn't the case in an ESOP. So the employees get the best part of the stock, and that's the value. So when they exit, when they retire, there's a put option back to the company to buy their shares of stock at current market value, and that's determined by valuation, because it's a private company. They're all private ESOPs. So the employees, what they receive in an ESOP is the value of that stock, a beneficial ownership of that stock. They don't have voting rights. They don't have the right to get disclosures on financial statements. They don't get to see that unless the business owner wants them to see it. That's always an option. But it isn't a right that they have as a stockholder because it's a beneficial interest they have in that stock. So at retirement, there's a put option back to the company, and that means that at retirement, the employees, whatever vested shares they have, they're going to receive that money on current market value for the shares of stock that they do own at retirement.
Okay. So if I'm understanding you correctly, if I've founded a business and I've owned it now 15, 20 years or more, and I'm getting ready to exit it, and my employees want to buy it, and maybe John and Bill, I'm just picking two names, they've been with me a long time and they want to acquire the business, and they say to me, I want to acquire it through an ESOP. They're not buying it through an ESOP. If John and Bill wanted to buy it, they would have to go as individuals, find money in a transaction, pay me for the business, and then they would own the business.
Correct.
Okay, so now John and Bill are going to participate in an ESOP, and they're key employees, right? Like
Right.
What happens now, if I'm understanding correctly, an ESOP would say, okay, we're going to create a trust, like for a lack of purpose, this is just a separate entity, which is called the trust.
Right.
That trust is then going to be capitalized,
Yes.
valued based off of the value of the business.
Right.
A bank or some other type of lender is going to provide capital to that trust to purchase the ownership interest from the founder or owner.
It actually flows through the company because
Okay.
the trust is a non-operating entity.
Okay.
So it doesn't have any cash flow. It doesn't have any way to support a loan. So basically the loan is actually to the company, and then the company loans that money to the trust to be able to buy the stock from the business owner.
And then the trust becomes the owner of the company.
Correct. One new shareholder only. That's the
Okay.
trust.
And then the employees get the profit interest and the beneficial ownership interest flowing from the trust to them.
There's a vesting schedule that's put together, and that's part of what Ambrose would assist with. And also the employees are going to earn shares of stock over time based on their tenure. And to your point about very important employees who are naturally higher compensated, the number of shares of stock that you receive as an employee is based on your salary level vis-a-vis the entire pool of salaries. Higher paid employees will get more shares of stock than lower paid employees. So naturally, the more valued employee is going to receive more shares of stock because their salary will likely be higher.
Okay. So now let's talk about, let's say as an owner, maybe now it's an owner or a group of leaders are thinking about, and they're saying, oh, ESOP, maybe it's an option for us. What do they need to be considering to think an ESOP is an option for them?
There's a few things. When I look to kind of size up a company to see whether or not it's a decent ESOP candidate, there's four things really I look for. One is the size of the company, and I look and the way that I determine that on the front end is just by their adjusted cash flow, annual cash flow, or EBITDA, earnings before interest, taxes, depreciation, and amortization. A lot of words. But basically, we take a look at annual EBITDA, and if that number is $1.5 million, and that's not a hard number in the sand, it's just a benchmark, or higher, then it's likely large enough to be able to support an ESOP.
Okay.
Number two, and this is more regulatory in nature, we need to have 15 full-time W-2 non-union employees at a minimum. 20 is better at a minimum, but 15 can work. So that's another benchmark that we look at for a minimum. The third thing, and you mentioned this earlier, is debt capacity. Whether the company has the ability to take on additional debt, because that is how, in part, ESOPs are financed. Typically what we see is an ESOP is financed by some portion of senior debt by a bank, and then the balance of it is held in seller notes by the seller. It's subordinated to the senior debt and repaid, the principal that is, after the senior debt is repaid.
Okay.
And number four, and this is not as tangible as the first three, but number four is that the business owner values their employees and want to do something for them. And they don't want to sell their company, and I get this a lot. I'm not going to sell to a strategic who's going to pay me a very high multiple, and then they're going to strip my employee base, because that's how they get their money back. And employers or owners who really value their employees and want to transition the company but keep them safe and keep their positions there, we'll look at an ESOP, because an ESOP will do that.
Interesting. All right, so let's talk about preparing for an ESOP to think if it's even an option. So you think about what you're thinking through from EBITDA, and you're thinking about what the employees may want to look at and the number of employees. So let's say you check those two boxes,
Right.
which a lot of companies probably do.
Yep.
And let me ask you though, when I heard bank debt, I think about like getting financed, and I know what it's like to get financed any type of significant amount of money. If a bank is going to finance an ESOP, to me, what I hear is, I'm going to ask a bank to pay a premium value for this business, which the founder is going to leave or exit. And then the business itself has to support the debt I'm going to put on it over whatever period of time. That to me sounds like a tough thing to finance. Like, what does that business and that owner who's now going to leave need to be, and the employees, what does the bank or the senior debt need to see in order to really feel comfortable putting forth that maximum value?
Great question, and there are several answers to that. First of all, usually the bank is going to finance about 25 to 30% of the total transaction. That's typical. So the bank is typically going to finance 25 to 30% of the ESOP transaction. The balance is going to be in seller notes behind the bank. So if you think about a company or a business owner that's going to sell 100% of their company, they're getting 30%, let's say, up front from the bank financing. That leaves them at risk for 70%. To your point, a business owner, an ESOP is not a good option for a business owner who wants to walk away on day one. They need to stay with the company. Now, they may have already groomed a succession management team, and maybe they're a helicopter manager, but nonetheless, a bank is going to look at whether or not that company can operate without the business owner, if in fact that's their plan, is to exit. But more than likely they're not going to. But the other safety net for the bank is the knowledge that there is 70% of that transaction amount at risk to the business owner if that company fails.
Okay.
So the bank is going to do that 30%, let's say, and then the business owner is going to hold 70%. There's a lot of tax advantages to ESOPs that we'll talk about, and that also makes the bank more comfortable because there's more cash flow being retained by the company in an ESOP transaction than there would be if there was just a leverage recap in getting the business owner that 30%.
Yeah, I mean, that's an interesting point, because even if the business doesn't grow, the fact it doesn't have to pay taxes is going to have an increased cash flow to the business itself.
In the S-Corp situation, 100% S-Corp, there are no federal or state income taxes. Of course, in Florida, we don't have any state income tax, but around the country there would be. The ESOP would operate on a tax-free basis if it were an S-Corp and 100% of the stock was owned by the ESOP trust.
Nice.
And if one more point on that subject, it's really whatever percentage of the outstanding shares of stock in an S corp is owned by the ESOP, that percentage of otherwise taxable income to the company is non-taxed. So if it's a 49% ESOP, because you can do partial ESOPs, and they're very common actually, but in the example of a 49% ESOP for an S corporation, 49% of that company's otherwise taxable income will be non-taxed.
Wow. So can a seller, an owner that's now holding a seller note, can they receive any money on that seller note while the bank's being paid to, like even interest or just not principal? I know it's subordinated, but can
Sure.
they receive payment also?
Most commonly, it's interest at a premium,
Okay.
and we kind of enrich that interest often with some warrants being attached to that note, so that the return to the business owner, some in cash, some in non-cash, is higher, because of course they're at more risk because the bank has the first position on all the assets of the company, and the business owner, those notes are not going to be repaid in principal until after the bank is repaid.
All right.
And what's real common too, Scott, is the bank will finance, say, 30% of the transaction. That loan is going to be repaid more quickly than it would normally be repaid because all of the tax savings that the company has, and that's being pushed back against that note. So all of a sudden, the bank had a 5-year loan, let's say, gets paid off in 3, and a good banker is there with no loans, and they're like, hey, why don't we finance another 30% out of that 70% that the business owner has? So we have our new loan. It's a healthy company. It's been paid back ahead of time. Now the business owner has another 30% of their money in pocket.
I like it. So this podcast is called The Construction MF'ers, right?
Right.
We have a lot of construction audience here. Why would an ESOP be something for a construction owner business or a construction-led business consider?
Sure. Construction companies, the construction industry in general is one that's somewhat difficult to sell in the open market and receive fair market value for the company. And because of that, business owners in the construction industry often look to ESOPs to get that accomplished, that sale accomplished, that transition accomplished, because an ESOP will pay fair market value for a company, and it's an opportunity to get their company sold and transitioned where they may have a difficult time doing that in the open market. Hence, a higher percentage industry-wise of ESOPs are in the construction industry than in other industries because they tend to gravitate to it.
I love it. So, if to talk about it, why would a construction company have a harder time in the open market than others?
Well, oftentimes, if it's, say, a general contractor, there are virtually no assets to sustain, the sale. Also, the construction industry is just a little more volatile sometimes, based on where the economy is, and that makes it more difficult too to get a good price for it. And it's tied to the business owner, and so they just in general are more difficult to sell.
I like it. So, all right, so let's think of like a perfect box, right? So you see a lot of different opportunities in your career, and every year you see companies come to you looking at an ESOP, and you ask the sets of 10, 15 general questions, and you get those answers, and you get your set of information, and you're looking at the box. And I'm imagining, just like in our world, sometimes you look down at that box and you're like, that is perfect. And other times you look at it like, okay, 80% of it's perfect, these are going to be problematic, blah, blah, blah. I guess my analogy, what I'm asking you is, show me and tell me what that perfect box looks like. When you look down at it, you're like, wow, this is the perfect scenario, perfect company. What does perfect look like? And I ask that because I want folks to listen, to think, okay, where they're listening to this podcast and maybe riding their car, they want to do an audit check. Like, where am I tight? Where am I not? Right. Where are my areas for opportunity? So define that perfect box.
Yeah, so it's a business owner. We've talked a little bit about some of those attributes. A business owner who really values their employees. That's critical, because if you don't have that in the scenario, then other problems could arise. In that business owner may want all their cash up front. They may want a higher premium for their company. Many business owners who really look at their employees as family, as appreciative of what they've done to make that company successful, and wanting them to have a benefit, which the ESOP becomes that for them, they will take a smaller price, if you will, than a strategic would offer. And again, in the construction world, that's a little more difficult or problematic, but in general, that perfect box is that business that is low levered, that is successful and not volatile. When you look at historical results for the company, it's steady or climbing, and the company does not have a lot of leverage.
Okay, so define leverage for someone who might not know what leverage means.
Sure, bank debt. So one of the things that we do at Ambrose Advisors when we profile a company is we talk about to the business owner about what they're trying to accomplish. We talk and ask about those questions about leverage and how much debt they have, etc. And then if all that green lights, then we do what we call a preliminary ESOP assessment. We do that at no cost to the client and at no obligation to the client. And why we do that is to do two things really primarily. One is to get a good estimate of value, because we're looking at financials and a lot of financial information that we request from the client. We come up with what we believe a good estimate of value is, and then we look at the ability for them to take on debt to finance the ESOP, whether that's there or not. And that's the leverage part of it. And in doing this, the reason why we want to do that is because many times business owners have an unrealistic expectation of what their company is worth. It's their baby, they built it. And if we look at a company and we say, we think it's worth somewhere in the $10 million range, and the business owner tells me, no, it's 20. Then we know we have a disconnect. And we want that disconnect, if there is going to be one, before the business owner starts spending any money on an ESOP. So we do that assessment first. It provides a lot of good information for the business owner about ESOPs, about their own company, and it kind of puts a spotlight on the company to let us know whether or not, again, where the business owner thinks they want to be in terms of the sale price and what we think the market will bear with the trustee and their buying of the company. We want that in sync. And if it's there, then we go on to phase one, which is where we really do a deep dive into the company's financials, really fine-tune that valuation, structure and model the ESOP for the business owner. And then phase two, as we call it, is where we go and assemble the team and execute on the transaction.
Okay. So let's talk about a few things you said in that perfect box. So we understand what low leverage means. You said a well-run company.
Right.
Define well-run.
Sure.
What does that look like in terms of executing on an ESOP?
Sure. So in an ESOP, eventually the business owner is looking to transition out. So if it isn't that they have a succession management team in place already that can operate that company in a very good manner, then they need to groom that succession team. And so that those periods of maybe 5 to 7 years that they'll stay on, it gives them that opportunity to groom that succession management team. Typically they have those people identified. Often they don't have them yet at a place where they can take over the company, but an ESOP gives that opportunity to the business owner over time to create that succession management team. So a well-run company would be one where if the business owner stepped away, the company will continue to operate successfully.
Nice. All right, so back to my perfect box. We talked about EBITDA. We talked about steady or growing. Tell me about what type of financial reporting is necessary and required, and what do those reports need to look like to actually be effective in an evaluation process for an ESOP, but also effective in actually executing to ultimately close on an ESOP?
Sure. Ideally, the higher level of financial reporting, that being either a review or an audit, is the way to go to be able to really support the best value for the company in the transaction. But also, back to your point previously about banks, they're going to require that kind of reporting for leveraging a company higher and higher and higher to be able to actually finance the ESOP. So I would say when a business owner is looking to the future potentially to do an ESOP or even just to do a third-party sale, the quality of their financial statements are going to be pretty paramount, because the buyer is going to use any weakness in the financial statements as a leverage for them to bring down the price of the acquisition, and that includes an ESOP.
An ESOP does it, so a bank will do the same.
A bank will do the same thing. A bank is going to look at a transaction and say, we can't really support a $10 million loan on compiled financial statements. So getting your record keeping in order and maybe lifting the level of reporting up in advance of doing an ESOP would be a good strategy.
And so going through the process of having either reviewed financials or really audited financials, where the bank can stand on the audit firm, the accounting firm that audited your financials, and stand on those, does it eliminate a lot of the question process in the evaluation? And
It certainly brings a level of comfort to the bank, because obviously, in the terms of an audit especially, you've had financial experts going in to verify the quality of the financial reporting that's being given. In the absence of that, it's really kind of up to whether or not the business owner or their CFO internally did the right things.
Mm-hmm.
So an audit does bring a lot of comfort to the banking side. Doesn't automatically mean that a loan is going to get approved or done, but it certainly increases the chances of a reasonable request getting approved by the bank.
Nice. Well, what I'm hearing when you say that anyway, I'm just hearing here's another great reason to have great financial reporting. Aside from the fact that it's much easier to run your business, aside from the fact that it's a lot easier to get a loan or a leverage or debt in any case if you need it. If you're trying to start to shift to bonded work, your surety is going to require it.
Absolutely.
And now if you ultimately do all those things great and you've worked your butt off for however many decades, and now you want to exit your company, you're going to need great financials anyway. Which leads to just earlier in the process, you set up great and excellent financial reporting with a great accounting firm that will work with you at whatever level you're at, and as you graduate to different levels in size and scope and complexity, you grow with that firm or you grow into another firm. It's really essential no matter what phase you're in.
Very true, especially in an industry that has that's considered somewhat more risky maybe than some others from a lending perspective, that being construction. It's always going to be to your benefit to improve your financial reporting and get a good accounting firm or CPA firm to provide you with those reports.
So you mentioned tax efficiencies in ESOPs too. What is the reasoning why an ESOP doesn't have to pay taxes, but yet the rest of us all do?
Well, an ESOP is by its nature a non-tax paying entity. And the reason why the IRS set it up this way, and ESOPs are also regulated by ERISA rules, much like a 401k is because of the benefit being provided to the employees. The employees are not purchasing the stock. I don't know if we touched on that point before. The employees are earning shares of stock. And so it's important to realize that this is a benefit being offered to the employees, and in order to be able to leverage the company to be able to provide this employee benefit, the tax advantages that we talked about, that being the non-tax paying S corporation, was put into place so that there would be extra cash flow to repay that debt.
Okay. And so now there's a trustee appointed to the ESOP.
Yes.
Okay. What is the trustee's role? Are they running the company? Are they involved in the day-to-day of it? Who do they work with? Who reports to the trustee? What is that?
Yeah,
explain that dynamic.
Sure. The trustee's main objective by DOL rules is really, number one, at the beginning of the transaction, to make sure that the trust, the ESOP trust, is not paying more than fair market value. That's the definition for the stock. And that's determined by external valuation. So there's, as I mentioned earlier, a negotiation between the seller, and we represent the seller in the transaction, the ESOP and their valuation firm, as to what the price is going to be. So that's number one. Number two is then to make sure that the ESOP is running efficiently and the reporting is being done properly, etc. That's what the trustee's real function is. They don't want to get involved in the operations of the company. If we do an ESOP for a general contractor, this trustee doesn't know anything about general contractor. In my personal opinion, in the absence of something very extreme, like the business owner decides that instead of making $500,000 a year, they're not going to make $5 million a year, that would, of course, deter the value of the company, and the trustee could, get involved in that situation. The trustee reports to the board, okay, and the trustee is assigned to being a trustee by the board, and so there's some checks and balances in the picture. But ordinarily, trustees do not want to be involved in the operation of a company.
Got it. And the board is picked by who?
So who's on the board? Usually it can be somebody internal to the company, but it's a good idea always to have the majority of the board members be external.
Interesting. So what are some key things about an ESOP? In the questions I've asked you, like what should have I asked you that I have not?
Well, we talked about one tax advantage of an ESOP. There are two others,
Okay.
and I think they're significant, and it's good to touch on those. Everybody likes to talk about saving taxes.
Oh yeah.
So as I mentioned, whatever percentage of an S corporation is owned by the ESOP, that is a non-tax portion of their otherwise taxable income. In a C corporation, and of course, before an ESOP occurs, we can convert an S to a C if this is what the business owner wants to do. In a C corporation, the tax advantage is actually to the selling shareholder. What happens in a C corporation, if the business owner wants to defer their long-term capital gains tax on the sale of their stock, I'll give you an example. Let's say it's a $10 million transaction, and ordinarily, for discussion purposes, we'll say that long-term capital gains tax is 20%. Let's say the business owner doesn't really have a basis in the company, so all $10 million is subject to that 20%. They're going to pay $2 million in long-term capital gains tax and pocket $8 million. When you do what we call a 1042 exchange or buy qualified replacement property, and not to get into the weeds on that, but there's a way to reinvest the proceeds, that $10 million in my example, where long-term capital gains tax is deferred and possibly even eliminated. And that deferral continues until that qualified replacement property, that reinvestment, changes. And if it doesn't change, the business owner just holds that position. When they pass away, their heirs are going to inherit that $10 million portfolio on a stepped-up basis, and long-term capital gains tax will never be assessed.
That's fascinating. Okay, so there's a lot of tax advantages. There's a lot of other, what I like to call noise and confusion around it. Hence why Ambrose Advisors exists.
Yes.
Right. When is the right time or the perfect time to reach out to you for, if you're a founder or an owner and you're thinking about this process, when is the right time to start working with someone or looking down the process?
I would say the earlier the better, really, because it's all about planning. And to your point about financial statement requirements, you know, if there's some deficit there, there's time for a business owner to improve that financial reporting in years past and going forward, so that when it is time to, you know, to execute either on a third-party sale or to an ESOP, that reporting is there. So I would say it's never really too early to talk about it. I like having conversations with business owners really early in the process, because even if they're not going to execute, they've got the tools to know what to do to plan for that exit, even if it's many years down the road. I'm working with a company where the business owner is 40 years old, and they approached me about having a business plan to stay another 10 years with this company and then do something else. And so, you know, he's way ahead of the curve.
I love it. Well, Manny, I got to say, man, this has been a very interesting, informative podcast episode.
Thank you.
I think folks are going to grab a lot to this, and I really appreciate you coming in.
Really appreciate the opportunity. Thank you, Scott.
How can people find you? Where's the best way to contact you? We'll share, obviously, your contact information in the show notes, but what's the best place to find you? If someone's listening right now, what do they look up?
Ambrose Advisors. My picture will be on there.
Nice.
And my contact information will be there under our staff. So, yeah.
All right. What about any social media? Are you on any social medias that you preference? LinkedIn or Instagram, or what's your favorite?
LinkedIn is my preferred.
All right,
Yeah.
Great. Well, Manny, thank you very much for coming in. I really appreciate it. If you found this episode helpful and informative, as I'm sure you have, please share the show. Give Manny and I both a follow on LinkedIn. You can get some great and excellent information on our YouTube channel at Mobilization Funding, as well as mobilizationfunding.com. And until next time, have a great week, and may God bless you.